Welcome to the August 8th, 2022 Advance Report for McGowan Group clients and NetWorthRadio.com listeners. I'm Spencer McGowan, your financial weatherman, with a fast-paced weekly tour of the global financial markets. Thank you for subscribing, and thank you for sharing with your friends that are interested in taking their investment strategy decisions to the next level. Let's cover currently what's going on, and then longer term, a plan to actually succeed in the current environment. A few things about the current environment. 528,000 net new jobs created in the month of July. What is that? It's actually not a recession, at least not yet. There are pockets of recession in retail. We cover more about that at NetWorthRadio.com, where you can get the charts and graphs along with the longer program that goes more in depth into asset classes and asset categories. Now, this was the S&P 500 year to date. At this point, it was down 26%. We're up 14%. The Fed just raised rates and pledged to do it again. Well, why is the S&P 500 up 14% since this low point of June 15th? We told you in the broadcast after that this looked a lot like the height of pessimistic selling, a capitulation sell-off, and sure enough it was. Why would it be up 14% just since June 15th? I have the answer, I believe, right here. Look at this. 430 out of 500 S&P companies have reported earnings for the second quarter. Now, you've heard it was a recession and it's going to be bad. Well, in this case, it wasn't bad in the second quarter. 15% sales growth for the S&P 500. So those companies had 15% revenue growth, earnings growth 9%. Where did a big chunk of that come from? This week, the energy companies reporting off the charts growth in profits, cash flow, raising the dividends. That was great news. Only two categories had earnings go down. Financials took more loan loss reserves and were comparing against 21 when they didn't have defaults from the pandemic generally, so they took it back into earnings. And then minus 17%, AT&T can't seem to get out of its own way. Well, the rest of the categories are positive, and all the categories were positive on sales growth. That says it was a much different picture than what we were told in June if we looked at the financial headlines. That's why YouTube McGowan Group is the place to come if you're going to invest 5 to 7 minutes a week. All right, here we go. What is this? This tells you that the Federal Reserve could actually go by March to 3.6%. That's good news if you like keeping a lot of cash, because your money market rates will generally go up towards that 3.6%. That's hiking up the short rates, pulling in the inflationary pressure of easy money, right? So it's a whole different environment. The bond market has done something curious. We're about to get to that. But then it says the Fed will moderate back down towards 2%. So the cost of capital went from near zero to potentially 3.5. Right now it's 2 3/4. That's the base lending rate. Everything else adds a premium on top of that for duration or credit quality. Well, this is a bizarre thing. What happened right here? Interest rates actually fell as the Fed raised the short rate. In fact, the 10-year went from 3.5 to 2.8% just since that June 15th meltdown where everybody sold everything. Well, what does that say? It says the institutions that buy bonds are either very worried about a recession or they are expecting that the Federal Reserve won't have to go much further. Now, whether that's true or not, stay tuned. We'll find out. The T-bill rate has gone to 2.5 because that's the base lending rate. Well, they raise the cost of capital for everybody. It pulls in the inflationary pressure. And here in the month of August, we're likely to get news that inflation has started to come down. We'll have more about that later in the month as we get CPI and other data. What is this? These are the 4 categories we want to be good at as investors. And I say categories because you can have different asset classes inside these. But this is a guideline for one of our disciplines, total return units. Growth with income, that's dividend companies generally. High cash flow, that's like global lending. You want to be the bank. You want to own a great basket of loans and bonds that are well managed, that pay you interest every day, and have a maturity value, and you want a manager that'll keep you out of the ones that default, right? So that's like corporate lending. Safety and income. Used to be municipals, you could get 8%. Now you would have to fight to get anything near 2% on municipals. So instead, there are other categories of safety and income. For the ultra conservative, we bought Treasury bills that are just 1 year at 3% just recently. That's not a bad deal. Floating rate loan funds fit in there. Growth with innovation. Remember, everybody went crazy over tech, and in November, everybody was buying tech. Well, I say everybody, we did not overpay for tech. We concentrated in other areas in growth with income, energy, medical dividends. You can see how this discipline is a framework, and sometimes it is better to eliminate one of these categories or reduce it, i.e. growth with innovation in November. You want to be good at all 4 categories, and you want to adjust for the economic conditions. In this chart, these are kind of the ideal adjustments you would make when everybody's pessimistic. What you want to do is become more conservative when everybody is optimistic. When everybody's pessimistic, you want to be opportunistic. And that is framed in these charts and graphs. What we're going to do with these charts and graphs, when you come in for your brainstorming session, we're going to use that as a template to say right now, what are the best asset classes, categories that can build a great portfolio, and how do we scale that in? So get to networthradio.com, fill out your preliminary client questionnaire, and we'll set your time for the brainstorming session that could make a huge difference for you and your family. I'm Spencer McGowan, President, McGowan Group Asset Management. Thank you for joining us. Thank you for tuning in to Net Worth Media today and our efforts over the past 2 decades to educate clients and help clients make great decisions. That's the reason that we're here at YouTube McGowan Group, Apple Podcasts, Net Worth Radio, and networthradio.com. The Net Worth Media effort is designed to help you make great decisions and address value at risk of loss, fluctuation in the markets. Remember, if we talk about a security, doesn't make it a recommendation until you come down and get a plan from McGowan Group Asset Management, the team that cares. You can set a Zoom meeting or an in-office meeting at the Crescent, and we'll give you a written plan that encompasses what we believe to be the best allocations. This is a team of 10 devoted to you. That includes the research that you see each week from Reuters, from Bloomberg, and from the best sources. We always post links at networthradio.com for what we believe can help you make great decisions, the research that comes up. Now, the Net Worth Media effort is also designed to address cycles in the market, value at risk of loss. At networthradio.com, you can get the ADV form that shows, yes, we're a fiduciary, a registered investment advisor. It covers the costs of hiring our team to help you in the future ahead. It really helps to have an expert team on your side that you can reach by phone, email, and of course, a team that's here for you every week to address what's going on in the markets, because anxiety can often lead investors to make decisions that are either dangerous, chasing things, or selling things when they shouldn't. And that's a big part of our planning effort at McGowan Group Asset Management. Thank you for tuning in, and we look forward to serving you and your family in the years ahead.